Okay, we're going to start some exercises now from chapter 3. The first one that was assigned was number 1, and it reads, classify the following items as accrued revenue, accrued expense, unearned revenue, or a prepaid expense. All right, so first, a 2-year premium paid on an insurance policy. So that will typically go to insurance expense at some time, so that's a prepaid expense. Fees earned, just not yet received. Well, if they've been earned, we just haven't gotten the cash yet, we have to accrue that revenue, accrued revenue. Fees received, but not yet earned. So we've got the cash, they paid us the cash, but we've not earned the service yet, so that's an unearned revenue. Salary owed, just not paid. That would be an accrued expense. Subscriptions received in advance. Also, we got the cash for all those subscriptions, but we just haven't sent the magazines yet. We haven't earned it, so it's an unearned revenue. Supplies on hand is a prepaid expense because that'll eventually go to supplies expense. Taxes owed, but payable in the following period, so it's owed, it's due the next period, but we've incurred the expense, so that's an accrued expense. And utilities owed and not yet paid, also accrued expense. Moving along to number 3, adjusting entry for accrued fees. So here, at the end of the year, 59,500 fees have been earned, just not billed. So what's the journal entry? Well, it's been earned, so we will obviously credit fees earned, some kind of revenue account. It just hasn't been paid. So then we can't debit cash, it has to go to a receivable. And it says in letter B, if the cash basis rather than the accrual basis had been used, would an adjusting entry been necessary? Well, the answer is no, because if we haven't gotten the cash, we don't record anything. But in this course, and generally accepted accounting principles, we are using everything on the accrual basis. Okay. Number 4, the adjusting entry for accrued wages was omitted at the end of the current year. Indicate which items would be in error because of the omission. Letter A, the income statement and the balance sheet. Well, if we didn't accrue for it, which would have been a debit to expense and probably accrued wages would have been the credit, accrued wages. Then the wages expense or any kind of expense is understated, right? Understated. Net income is overstated because revenues minus expenses gets us our net income. Well, if we don't have a number in there, then this is going to be too high. Our expenses are understated, our income is overstated. Obviously, this liability is also understated. And just because of the accounting equation, assets equals liabilities plus owner's equity, our retained earnings, our stockholders' equity section would be overstated. So our liabilities, that's what I really want you to see here, is that would be understated. All right, number 5, it reads, this realty pays weekly salaries of $25,500 on Friday for a 5-day work week ending on that day. Journalize the necessary entry, assuming that it ends on Monday and on Thursday. Well, if $25,500 is what is paid weekly, then 1/5 of that is earned each day, Monday through Friday. However, on this case, it says here in letter A that the period ended on Monday. So we need to accrue of the $25,500, 1/5 of that. 1/5. So we're going to debit the expense and credit the payable. 1/5 is getting accrued. Letter B, it just says, now The period end is Thursday. Monday, Tuesday, Wednesday, Thursday is 4 days. To accrue 4 days, we take 4/5 of 25,500 and we get 20,400. Let me explain it this way if you're confused by the 1 day or the 4 days. Let's just assume we are in the month of January and the payroll, the 31st, ends on a Monday, but it's paid the next week. Well then, because Monday was on the 31st and it's paid, even if it's paid later in the week or the following week, that 31st needs to get accrued back into January, because you will write a check for $25,500, which will include January 31st and then February 1, 2, 3, and 4. January 31st is a Monday, and let's just say February 1, 2, 3, and 4 is Tuesday through Friday. So we need to accrue that 1 day into January, and we'll leave the other 4 of the 5 days in the month of February. Number 7, again, omitting an entry here. Accrued expenses owed to employees for October 30 and 31st are not considered in preparing the financial statements. Indicate which items would be wrong because of this error. Okay, so the income statement. Well, if you didn't, just like the other one, if you didn't accrue that expense, your expenses are going to be understated because you didn't put it in there and it should have been. And of course, your net income is going to be overstated. Your liabilities right here, right, is going to be understated also. And that's just exactly like this one. Your expenses are understated. Your liabilities are also understated. So if we don't do it, we're going to have understatement in our expenses and understatement in our liabilities. The balance, number 9, the balance in the unearned fees account before the adjustment is $18,000. Journalize the entry required if the amount of unearned fees is $36,000. So $3,600. So what they're saying is what is still unearned is the $3,600. So if $3,600 is still unearned, then we need to take $14,400 out of unearned and move it into earned. So unearned fees, as described in the text, in the reading, and in those videos, unearned fees is always a liability. Always a liability. And not until we earn it do we take it out of the unearned fees, normal credit balance, and move it into earned fees. So we move it out of one and move it into the other. So again, an example. Why would you have something in unearned fees? If you rent an apartment and they ask for a $5,000 security deposit, and let's just say you're renting along, everything's going great, and while you are at USF, your apartment complex burns to the ground. Well, then that $5,000 security deposit, last month's rent, whatever you want to call it, is never going to become earned. You will never get to that last month because today the building burned to the ground. That last month's rent could have been for next month or some other month, but you've already paid this month's rent. So that unearned rent, that security deposit, is a liability, and what we would do then is debit unearned rent and credit cash. We have to return it. So when we got it, we debited cash and we credited unearned whatever, and now we have to give it back because we're never going to get to that last month. Number 10, at the end of October, the first month of the business year, the usual adjusting entry transferring rent earned to a revenue account from the unearned rent was omitted. Okay, what does that do to the income statement and the balance sheet? So Rent revenue, which should have been recorded as earned, is understated, right? It was earned. It's still sitting in unearned, but it should have been moved to earned, so it's understated. Of course, our net income is also understated. The unearned rent, which we said was a liability, is overstated. This liability is overstated because we should have taken it out and moved it into earned, which is exactly this entry right here, moving it from unearned to earned. Moving along to number 11. The balance in the supplies account before the adjustment is $9,000. Journalize the adjusting entry required if the amount of supplies on hand is actually $1,575. So there's a supplies room. We put $9,000 worth of supplies in there. Over the course of a month, a quarter, 6 months, we take supplies out. We don't want to record every time a ream of paper is taken or every time there's a pen removed. So at the end of June, we count how much do we actually have in the supplies room. Well, it was $1,575. We still show $9,000 in that account, which means we need to reduce the supplies account by $74.25 and move it all into expense. Because from January through June, we must have used $7,400 worth of supplies. Number 13, at March 31st, the usual adjusting entry transferring prepaid insurance to an expense account was omitted. So what happens to both the balance sheet and the income statement? Well, insurance expense, of course, if it hasn't been moved from prepaid, then our expenses are understated and our net income is overstated. Prepaid insurance, of course, is still overstated. So again, our insurance expense is understated, our net income overstated, and then our prepaid insurance, of course, is still overstated because we still have it in there and we shouldn't. Number 14, what is those journal entries that kind of relate to number 13? So here, the balance in the prepaid insurance account before the adjustment was $27,000. Journalize the adjusting entry required under each of the following alternatives. So letter A, they're telling you the amount of insurance expired. So they're telling you what needs to be expensed. Insurance expense for $20,250. Prepaid insurance needs to be reduced by $20,250. The other angle is to say, well, letter B, the amount of unexpired. The amount that still should be in prepaid, is $67.50. Well then, what's the difference between $27 and $67.50? Still the same amount, still the same entry, but there's two different angles. They either can tell you what needs to be expensed, or they will tell you what is still left. Number 16, the balance in the unearned fees account was $97,770. Of this, $39,750 has been earned. Okay? And let's just look at that first. So that's what's been earned. So we'll take it out of unearned and we'll move it into earned. Just exactly what they told us. Letter B, it just says, in addition, $24,650 of these fees have been earned, not billed. So now we have something that has been earned for $24,650. It just hasn't been billed. We've earned it, but yet we need to bill it. So we will debit accounts receivable for $24,650. We will stop for a moment and we will pick this up again.